Welcome back to Brave Ideas. Today we've got an insightful episode featuring Kylie VanBuren, Director of Real Estate Transactions at Industrious. Industrious has grown to 160 locations in more than 65 cities across 9 countries. Prior to Industrious, Kylie was a transaction specialist at CBRE in the Big Apple, New York. In this episode, we get a first-hand perspective as we peel back the onion on the evolving relationship between landlords and flex operators. Kylie unpacks the shifting dynamics of landlord-operator partnerships and the power of transparency in building long-term success. This episode is packed with lessons for both landlords and operators adapting to the changing nature of collaboration between the two parties. Joining me to introduce this episode is my friend Sam Gamble, co-founder of Return Suite, our headline sponsor for this season. Sam, Kylie shared a lot in this episode. What was your favorite discussion point from the conversation?
Yeah, I mean, this is one of these episodes where there's just so much detail. I love listening to these types of episodes when you do them and really dive deep into it. And one of the kind of really interesting takeaways, it was almost like a throwaway line that she mentioned about how Industrious works with their landlords' lenders to help the lenders understand how to underwrite having flex in the building. And I thought that was really fascinating.
Why did that resonate with you so much?
Yeah, really everybody's kind of in the same boat, right? And kind of on for the same ride. So you have the landlord, the operator, the lender, and, if there's any kind of exterior investors as well. And really everybody has to kind of understand what the risks are and what that kind of cash flow waterfall looks like. And I really like how kind of Kylie really got into that and really pulled back the curtain on how some of that works. And it's really interesting because, Industrious is a real leader in modeling out this type of stuff, really getting to see kind of how they do their agreements and how that translates into kind of financial arrangements I find fascinating. This is the type of stuff I really, really like hearing about.
Well, we've talked about data throughout this season, and Industrious, because of their portfolio, has a lot of data. When she talks about in this episode shifting from lease-based models to partnership agreements, as we're seeing a trend in the industry, Industrious has been doing that for a long time. Do you think there's a signal to be found in here that we'll see other operators following suit?
I think so. I think from kind of my understanding is what they're doing is a management agreement, but it's really kind of more of a hybrid as well. And I think we're starting to see the industry kind of coalesce around a certain kind of solution that helps landlords, kind of gives everybody the components of the solution that they need, that lenders are comfortable with, that investors are comfortable with, that kind of give landlords what they need and are still set up in a way that operators can earn some money and share in that risk as well. So it's interesting.
Well, we saw her speak on the panel, and it was an interesting dynamic between her and Andrew from Brookfield, and obviously we work on the panel as well. I asked her in this episode a couple of questions about that, so I'm really excited for the listeners to hear Kylie's perspective, especially around the expectations around transparency and building these lasting partnerships with landlords.
Yeah, definitely. I think everyone's going to really enjoy this.
Thanks, Sam. Well, without further ado, let's go ahead and dive into this episode. Welcome to Brave Ideas, Kylie.
Thanks for having me. I'm excited to be here. First podcast. Well, I'm very happy that you agreed to do this.
It's really cool that we did this right after your panel earlier.
Yeah, such an amazing conference. It's really nice to get to see everyone sort of in the industry and be in a room full of friendly faces.
Absolutely. I was talking to Sam about that yesterday, about how it's like it's like a reunion with all your friends,
Yeah, it's so fun in that way. And there's more and more flexes getting the big stage, so it's great to see.
Absolutely, and Gio, I think, does a hell of a... Sorry, we got some food coming over here. We're actually sitting here having coffee and water at Arch Amenities in 140 Broadway, just to set the scene. Your panel just a minute ago was with Brookfield, WeWork, and Industrious, you guys. And you were talking about the relationship between the landlords and the operators, whether that's a lease or a management agreement or somewhere in between.
Yeah.
Can you sort of give your thoughts on how that panel went?
Yeah, I thought it was really fun. I so enjoy when you have the opportunity to have candid conversations with other people who are thinking about things both in a similar and different way from you. So obviously WeWork had a long lease-based model. We've done revenue share agreements. I think we're all moving in similar directions. of how we're thinking about growing now. And so to get to discuss that, but also discuss what's going well in our industry and some of the challenges of it, and do so in a candid way versus just in a like, this is my pitch and my company is always, I think, the most fun panels. I've gotten to work with Andrew a bunch of times over the years. Knew him in his former Flex life when he was at Notel, and now to get to do things with Brookfield as well has been really fun. So it was a friendly face panel and a fun room of questions too.
Yeah, definitely. It was great to have those perspectives from both sides of the fence, so to speak.
Yeah.
I was fascinated to hear that Brookfield, one of the largest landlords, if not the largest landlord in the world, they had 1.8 million square feet of flex or co-working in their portfolios.
Yeah.
And I guess wanted to ask you, just from a partnership perspective with landlords, are you seeing that relationship change in any way in landlords' expectations?
Yeah, I mean, I think I said it a little on the panel, but I've been at Industrious 6 years. If you told me that in the majority of conversations that we start off having with landlords, that they're expecting a revenue share, that they're comfortable with a revenue share, that they understand sort of the management agreement model holistically, and they're ready to start the conversation from there about how do we get something done together and create a partnership, versus it's like selling them on the model holistically. I would be really surprised to see that success, and it's really, really great to see. I think landlords are seeing flex in general as a real asset to their amenities. They're thinking a lot about the ecosystem of their amenities. There's a part of the return to office of it all, but it's also how do you as a landlord create a specific brand that people know your name, know your brand, helps you with tenant retention, and to be a part of that story, I think has worked really well for us, both from the actual like flex office, private office sort of co-working model, but also from the amenity management side that we do with a lot of these landlords. So the conversations are, they're never easy because every deal is so specific and every asset is so specific, but they start in such a better place than they did before. And I think it's cool to just see everyone understand that flex is like a real part of the story in a positive way.
It's more collaborative today than it was in the past, and when it was just a landlord-tenant relationship.
Yeah, definitely. I mean, our whole purpose of doing sort of the partnership model is we didn't want to be adversaries to the landlord. We didn't want to be competing over tenants. We wanted to be on the same side of it. And if that means that we can start someone in an industrious space and they grow up and they end up taking a full floor in the building or a spec suite in the building, that's a great outcome for us, and it's a great outcome for the landlord and their story. And if it means that there's an opportunity in the future to get rid of ROFOs and ROFers, the dreaded options for landlords, because people are going to use flex in a different way as their headcount shift up and down. That's, I think, a great story for both of us as well.
You touched on the WeWork lease model, and we've seen the stories. We won't get into that here.
Yeah.
You guys pivoted away from a lease model, and because I think, correct me if I'm wrong, you guys, Industrious started as a lease arbitrage model and pivoted quickly to the partnership model.
Yeah, I think by end of 2018, good timing, we had enough operational history, because how can you shift to a new model that no one has ever done in office before without the proof in the pudding that you're like actually good at this from an operations and hospitality side? And from our C-suite, had a really great idea of this could be the future of growth, and this was the best way to make us a long-term sustainable company. Thankfully, that happened in 2018, which means our deals in 2019 had already switched over. And then we've been pretty successful both during COVID and then in the years after of converting some of those legacy leases over to some sort of partnership agreement. So the majority of our portfolio at this point is some form of partnership agreement, which is great to see.
So does that mean that a minority, you still have some leases across the portfolio?
Yeah, we still have some legacy leases that landlords, they had the right to keep it as a lease, and they were locations that we wanted to be successful in. It's not to say they didn't work with us in different ways during COVID, but in the long term, they felt the lease was the best for them. And I don't think we're not growing under leases, but if you have a successful location and a legacy lease, that's okay.
And do you think there's a bit of a mindset shift between operating under a lease model with a landlord and then operating under a hybrid or a management agreement model with a landlord in terms of how you engage in that partnership? Is there just a different mindset?
Yeah, I mean, if I was growing under a lease-based model, it would be a lot easier to grow and grow at pace. Partnership agreements take a long time to negotiate. There's a lot of education that goes on. A landlord really needs to fully understand your operational history to understand why you're going to be successful and why the underwriting that you put in front of them is real, because they're basing so much on that. They have to believe that you're going to be able to achieve that variable rent for the deal to make sense for them. They're a lot more involved. In a lot of our deals, we end up talking to lenders in the building to explain what we're doing as well. And then the most successful landlord relationships are one that view it not just in the four walls of the pro forma of this actual co-working space, but see the value for their building overall. I think in the long term, what we'll see is buildings with flex will have better retention of tenants holistically. It's obviously traditional landlord lease cycles or traditional tenant lease cycles are long, so it takes a little bit to get that data, but I think that's what we'll ultimately see.
I guess, are you seeing more competition when you pitch a landlord? And the second question to that is, because managing a landlord partnership under a management agreement requires a different mindset, do you think everyone's set up to be able to deliver the level of transparency that's needed?
It's really interesting. Am I seeing more competition again since COVID? I would say yes. I would say past 6 months, last year, both from like national operator side, sort of your name brand flex operators, and also the local operators who have continued to like survive. The ones that have survived and created really incredible spaces within their community and know their community really well. Yeah, we're competing with them. Some of them we're competing with and they want to do a lease and we want to do a management agreement, and that's always
difficult.
An interesting.
Because the landlord wants the lease, right?
Yeah, like there's some extent that they want the lease, but regardless the operational history of whether you do a lease or you do a management agreement, you have to believe that flex is going to be there in the long term, because the space that you're building out is pretty specific to flex. So you want to know that you're going to be successful whether it's a lease or a management agreement. So seeing competition overall, seeing more and more operators do some sort of management style agreement, I think that's great for the industry. I think the more people that are doing that and having the conversation, I don't think we need to differentiate ourselves by our model. I think we can differentiate ourselves by the hospitality level, like operation level that we provide, and then our scale. I think that's how Industrious will differentiate ourselves. We don't have to do it just by we do this economic model. So I think it's great for everyone. I think it'll make flex more sustainable in different economic cycles. And so many people think about individual operators, but so many people think about flex as a sphere. So flex doing well, I think helps everyone. And that's what we want to see.
Yeah, absolutely.
In terms of the setup, I would say we have a really strong finance team at Industrious, and a big finance team, because you're doing, to some extent, every month a reconciliation of the dollars coming in, and you're doing so across a large amount of units. So you need to be able to get landlords their payment on time. So you have to be able to calculate everything before, make sure you're running things through these waterfalls, because each deal is unique. My finance team, we have good relationships. I went to drinks with them last night, but I definitely create a harder time for them by each one being its own thing, so it's not so stamp and repeat. So we have an incredible team that is able to get that done, but yeah, you need a decent amount of infrastructure behind it.
Yeah, I appreciate you mentioned the word differentiation, and where do we differentiate as different brands?
Yeah.
Just reminded of Andrew's comments about from the panel about the financial track record and history, the data behind that. You mentioned it a moment ago. I want to give an example to set up a question. A couple years ago, I was involved in a pitch through a tendering process. Landlords looking for flex operators to come in. It was a location that was, it was a premium asset. The location wasn't the best. It wasn't horrible, but what that meant is a premium product could go in there. But if you look at the market data and you buy the reports and all that, you can look at the market data to say, okay, well, here's what we think pricing could be. We had to go a little bit below the top of the market as a premium product because of the location. So to be conservative in the forecasting, we put something forward. We lost that deal though, because another operator put above market rents in there. They were very optimistic in what they could do. And ultimately we were told that we were too conservative in our forecasting. That's why we lost the deal. That's what the agent said. Fast forward 2 years, now that operator's having difficult conversations with that landlord on their performance. So that's all to say, where do you think the industry's headed, or where does it need to head, so that when there is the tendering process, or when an agent or a landlord is looking at different operator brands.
Yeah.
How do we get to an apples to apples, even if there is going to be some differences in that?
Yeah, it's a good question. Look, I hold my team accountable to underwriting conservatively. I think we have to, because if we're not hitting our projections, that's harder to go out and pitch. It's a small real estate community. People are going to talk about the success of the units, and if we're not hitting our projections, then we put something that's too aggressive. Like, obviously there are market cycles and things shift overall, but if you're assuming straight down the fairway sort of underwriting, you should be able to hit that. Our sales team and our operations team hold us to that as well, because we try and take a transparency first approach in what we share with landlords. Across the industry, it's really interesting. It's even knowing that, like, as I enter new markets, I'm trying to benchmark and get pricing. Like, sometimes that's having brokers cold call, or like they have relationships, or they put someone in there in the past and you can try and decipher. But all of our pricing is so different and unique to each operator. You don't necessarily know what you're getting in that bundle of things. It's really hard to compare across. So I could totally see a world, and I think VTS has talked about doing it. I think CoStar's talked about doing it, where there's just more market reports in general. There's more flex specific sort of drop downs that you can do to see sort of comparatives. And I don't think that's a bad thing. I think everyone's sort of history out there ultimately will, I think, support our thesis as Industrious, that we're really good at this and we run really good locations. But I think it'll also help us from like getting banks to buy into underwriting flex. I think the more information that's out there, the more that we can look at us being, you know, maybe in an Argus model in the future. And so it's not just you're a certain percentage of the building, we don't have to think about it as much, but it's you actually get value for what you do.
Can you elaborate when you just said Argus model?
Yeah.
Go a little bit deeper on that.
Yeah, no, it's such a nerd of me. Valuation of buildings being underwritten traditionally using Argus models. Obviously, a lot of these different lenders and banks have their own models that they're doing as well, but an Argus model is sort of an industry standard still of how people look at valuation. And right now, flex is viewed as a traditional tenant. No one really knows what to do in that with like the variable stream. Our hope is that by us being able to provide a premium return to landlord, that if they discount from our premium, you get back to market rent and you don't hurt the valuation. But it's so specific to who's actually looking at the valuation of that building, who's thinking about buying it, who's trying to refinance it. And I can see a world where we just, as we continue as flex to grow as a piece of the industry altogether, they just can't ignore it. They can't just say, this is a piece of it and I don't really understand it, or I'm not going to give you credit for it. Instead, it becomes something where we, you know, the value of what we do is viewed in the value of the building.
And when you're sitting down with a landlord, talking about this partnership opportunity, going through your underwriting, are you feeding into your underwriting the landlord's hold period, the market risk they're trying to achieve, obviously, and then playing forward some potential exit scenarios, looking at maybe some cap rates in the future? Because you mentioned the premium, but the discount the premium back to...
Yeah. I mean, cap rates is really hard to do because they're never going to be fully transparent on the valuation of their entire building and all of the other leases that go into it. So it's hard from a flex operator side to just be like, this is how I think will impact or not, especially because some of that data is just not out there. There haven't been that many buildings sold with flex, and particularly flex under a management agreement, done yet. There's like a handful of them, but I don't think a handful is going to give us the data set we need to like prove something out. The data from the landlord too that I'm looking at, and the best conversations that I have when I'm having these sort of partnership underwriting conversations with them, is I'm going to know the tools that I have to make these deals shift and move a lot more than a landlord will, because they haven't done something like this. So the best conversations are, talk to me about what your net effective rent that you're trying to achieve is. Talk to me about where your sensitivities are from a capital side, or if it's about lease up in your building, or if it's about creating amenity play. And let me help us have an open conversation and structure something that like works for you and works for us. And I might be able to put something in your court faster, that since I do this on scale, than you as a landlord doing this for the first time might be able to do it.
So when you're underwriting this partnership agreement, are you always using the same waterfall effect? Does that shift?
Yeah.
Depends on how much money they're putting into the deal. What are the sort of variables and levers you pull?
Yeah, each one is so specific to the deal. Obviously, capital landlord's putting in because Industrious is an asset light model, so that capital is a big piece of it. It depends on market rents. It depends on how the building is doing successfully overall. If it's a location that's a prime location and we're focused on getting in, there are times I can be more aggressive, whether that's from a percentage of fixed rent or it's from some sort of pref to them in the waterfall. But a lot of what we do at this point usually has some sort of promote waterfall structure in it. I think it aligns incentives really nicely. And I wish that it was a little bit more stamp and repeat, but there's so much that we're solving for in each of these deals, that each one is so specific to what the landlord needs and what we can achieve too. And there's a pricing aspect from the Industrious side. And then there's at times even like a market rent of a building in an A+ location, but that's an A- building versus an A+ building might have a $10 shift in like what you think a market rent could be. And it's solving for that arbitrage as well. So it's so specific to each one.
You must have this like massive spreadsheet with a lot of different drop downs for variables.
Yes, we have a pretty cool model. We've tried to simplify it over time since we are doing this at scale. But yeah, a lot of different variables. And it's just so much of it is a conversation about what are you trying to achieve here?
Yeah.
Why do you want flex? Why do you care about flex? Are you optimizing just for your return here? Or are you thinking about what this can mean for your building holistically?
Hey everyone, Caleb here. Let me tell you about something that's going to totally change how I work with real estate spreadsheets. If you've ever been stuck in endless tabs of complex cash flow models, you know the pain I've experienced. I just saw a demo for Return Suite, and I've got to say, I'm excited to try it out. This platform is about to make our lives so much easier. You can model cash flow scenarios in minutes, not hours. It's like a breath of fresh air. And here's the cool part. Their co-founder, Sam Gamble, who helped kick off this episode, is looking for 3 beta partners to test their flexible leasing model. Whether you're managed co-working spaces or flex inventory, this is your chance to get early access to something groundbreaking. Let's simplify financial analysis together. Join me as a beta partner and check it out at returnsuite.com/brave.
Well, this has been great. Thank you very much. I have one sort of final question. Maybe it's a part 2 question. I'm not sure how it's going to come out yet, but
Okay.
you have your model,
Yeah.
and presumably you're submitting a pack to the landlord when you're submitting your proposal to them.
Yeah.
You mentioned Argus earlier. Some landlords are on sophisticated spreadsheets. Some use Argus. Some use other tools. Do you have a preference on how that gets delivered, and are you able to allow the landlord to make tweaks to whatever you submit so they can change and see what happens when they make those tweaks?
Yeah, so we have an Excel-based model. Our internal model has a lot of inputs on like things that don't affect the landlord, like our unit level operating expenses and things like that, that are usually covered by Industrious under this waterfall. It's our responsibility to handle. So those aren't built in the same way into what the landlord sees. We usually send a pro forma package that has a PDF, but one thing that we're like very comfortable doing is sending over a simplified Excel version of that model so that they can play with the different inputs and they can test sensitivities, and I think that usually really helps people sort of understand and pressure test sort of different assumptions. And you want them to be comfortable with the base case occupancy scenario, but you also want them to be comfortable with a downturn scenario. And I think the more that they can understand and play with that themselves, like it tends to work out best. So we share that out there. We'll give that to landlords. It makes it easier than them building it themselves. But it's a pretty simple Excel model at the end of the day.
And they can look at, okay, like you said, downturn, here's the worst case scenario, here's the best case scenario, and here's sort of an average scenario. They can see all of that.
Yeah, they can change pricing, they can change occupancy, they can change splits. So like sometimes I'll give it to them and they'll come back and negotiate, but that's part of the game of it all. And so they can see like what they need their outcomes to be. And obviously we know our internal model really well. And it's become a fun thing for me and my team to get to sort of intuit, okay, we're starting here. How much room do we have in this negotiation, and where do we think things will move throughout the negotiation? And can we end up in a spot from where we started going out to where we end up that we still feel good and we can get past our internal investment committee as well?
Right. Well, that's very, very, very wise, and I would love to see that one day, of course. But I have. I lied. I had another question.
Okay.
You made me think of something. So on the panel, I thought it was. I kind of chuckled a little bit inside when they were asking like, what's an ideal landlord-operator relationship, and what's a successful one, and what's an unsuccessful one.
Yeah.
And when they came to you about the unsuccessful one, you had to think for a second as if you never experienced an unsuccessful landlord relationship. But I want to give you the opportunity here to sort of say what you think an unsuccessful relationship is and how do you avoid those?
Yeah, I think an unsuccessful relationship in this day and age is you're going to have an agreement over the course of 10 years. That's a long cycle. That's a lot of different economic cycles. It's a lot of different real estate cycles. And I think Industrious is incredible at what we do. And also we play in the sandbox of what's happening in the larger real estate market. We're not completely divorced from it. So there are landlords at times who would want us to be able to bring something to their building that they're not even delivering themselves. In a 50% vacant building, yeah, we can do everything we can, from the amazing hospitality package to focusing on marketing and sales to bring people in. But if your building's not occupied and you're in a submarket that isn't doing successfully, we can do our very best. We might be more successful than a traditional tenant, but we're not going to be a magic bullet that's just going to defy everything else going on around it. Our most successful locations are in locations where people want to be, which I think we're seeing from the entire shift in the real estate market is the flight to quality and the live, work, play. So it makes sense that as great as what we are, what we do and who we are, our members are similar to other people who want to go to work in a vibrant place. So that's I think at times where you can see just a difference in thinking. And
it's about getting alignment.
Yeah, it's about getting alignment. It's about getting alignment. It's about being realistic about what's going on around you too.
Awesome. Well said. Thank you so much for taking the time. Well done on the panel.
Thank you.
And enjoy the rest of the show.
Yeah, it was really fun. Thanks for taking the time to chat with me.
Thank you for tuning in. Until next time, take care of yourself.
If you've enjoyed this episode, you'll enjoy our Brave Ideas newsletter. Subscribe today by tapping on the link in the show notes. And don't forget, I'm always on the lookout for buildings to acquire and reposition with brand-led hospitality. If you know a building I should look at or an owner looking to sell or partner with, drop me a DM or contact us at bravecorp.co. Until next time, take care of yourself.